It's a story as old as the stock market itself. A company emerges, brilliant and unstoppable. It crushes its competition, redefines an industry, and its stock price becomes a rocket ship aimed at the heavens. For years, it delivers staggering returns, making ordinary people into millionaires. And we, as investors, watch this ascent with a mix of awe and envy. We see the charts, we read the headlines, and a powerful, almost primal instinct kicks in. We feel an overwhelming urge to be a part of it. We want to own a piece of that universally acknowledged greatness. We believe that buying the best, biggest, and most dominant companies is the safest and surest path to building our own wealth. This belief feels intuitive. It feels safe. It feels right. And yet, embedded deep within this comforting logic is a hidden trap, a mathematical certainty that has quietly destroyed more portfolio growth for more well-intentioned investors than almost any other single mistake. It's the simple, brutal truth that great companies, at a certain point in their life cycle, often make for lousy stocks. The mistake isn't in identifying the great company. The world knows which companies are great. The mistake is in projecting the past into the future. It's the dangerous act of looking at a company's spectacular growth rate from the last decade, when it grew from $10 billion to $500 billion, and unconsciously assuming it can repeat that same percentage growth over the next decade, starting from a base that is 50 times larger. This is a mathematical impossibility, a direct violation of the law of large numbers. And when you pay a premium price for a stock, a price that has all of that impossible future growth already baked in, you are setting yourself up not for spectacular gains, but for years or even decades of agonizingly stagnant returns. You have fallen for the market's most seductive illusion that yesterday's heroic growth can continue forever. Warren Buffett, the master of avoiding these popular delusions, has built a multi-hundred-billion-dollar fortune by understanding this single principle more deeply than anyone else. He knows that the price you pay for a stock is not a ticket to its past glory, but a claim on its future earnings. And if you overpay for a future that cannot mathematically happen, you have already lost the game before it even begins. This is the silent killer of portfolio growth, the hidden reef upon which countless investment ships have been wrecked. Today, we are going to dismantle this trap piece by piece. We will learn to separate the celebrated company from the intelligent investment, to replace hopeful extrapolation with realistic projection, and to understand the single most important rule of investing. Your return is not determined when you sell, but on the day you buy. This is the key to protecting your capital, to achieving true, market-beating returns, and to transforming yourself from a mere market participant into a disciplined and rational owner of businesses. The first step in disarming this trap is to understand its magnetic pull. Why are we so drawn to the Goliaths of the stock market? It's because the allure of the unbeatable champion is one of the most powerful psychological forces in finance. We are wired to believe in momentum, to worship success, and to seek safety in the consensus. We see a company that has dominated its field for years, its brand, a household name, its products woven into the very fabric of our daily lives. And we make a critical leap of faith. We assume that this operational dominance automatically translates into a wise investment, regardless of the price tag. This assumption feels safe, but it's often the most expensive one an investor can make. To understand how to resist this pull, we must first examine its source, and there is no better story to illustrate this delicate balance between a great company and a great investment than Warren Buffett's landmark purchase of the Coca-Cola Company in 1988. It's a story that, on the surface, seems to contradict our thesis. He bought a massive, well-established blue-chip stock. But it is in the asterisk why and untie when that the entire lesson unfolds. He didn't buy Coca-Cola because of its past. He bought it because the market was misinterpreting its future. By the late 1980s, Coca-Cola was already an American institution. It was a titan of industry, a global symbol of capitalism, and a company that had been a staple in American households for a century. On Wall Street, however, the perception was that its best days were behind it. It was seen as a mature, slow-growing utility, a relic of a bygone era. The stock had gone essentially nowhere for years. The memory of the disastrous New Coke fiasco in 1985 still lingered, a painful reminder of a company that had perhaps lost its touch. Then came October 19, 1987, a day forever known as Black Monday. The stock market experienced its largest single-day percentage drop in history, plunging over 22%. Panic gripped Wall Street. Investors were dumping stocks indiscriminately, selling everything, good and bad, in a desperate flight to cash. In the midst of this chaos, Warren Buffett, sitting in his office in Omaha, Nebraska, saw not terror, but opportunity. He saw the market's short-term panic creating a long-term bargain in one of the greatest businesses ever created. Over the next several months, Berkshire Hathaway began to aggressively accumulate shares of Coca-Cola. By the spring of 1988, Buffett had invested over $1 billion, acquiring roughly 7% of the entire company. To the buttoned-down world of institutional finance, this was a baffling move. Why was this legendary value investor, famous for buying obscure, statistically cheap cigar-butt stocks, suddenly plowing a huge portion of his capital into a well-known, large-cap stock like Coke? And he wasn't even getting it at a rock-bottom valuation in traditional terms. The price-to-earnings ratio was around 15, not the single-digit multiples he was famous for. The financial press was skeptical. They saw Buffett buying a company whose domestic market was saturated. How much more soda could Americans possibly drink? They saw the recent stumble with New Coke as a sign of weakness. They saw a giant that had stopped growing. But Buffett saw something entirely different. He wasn't looking in the rearview mirror. He was looking through a telescope. What Buffett understood was that the market was anchored to Coca-Cola's past identity as an American beverage company. But he saw its emerging reality as a global logistics and marketing powerhouse with an unparalleled distribution network. He knew that while the average American drank hundreds of servings of Coke a year, the per capita consumption in much of the rest of the world was in the single digits. The domestic market might have been mature, but the international opportunity was breathtakingly vast. He wasn't buying the company based on its last 50 years of growth conquering America. He was buying it for its next 50 years of growth conquering the world. He saw a brand that was not just a product, but an idea, an aspiration that translated across any culture. He saw a business that required minimal additional capital to expand, meaning its growth would gush free cash flow. He saw a new S-curve of growth just beginning, while the rest of the market only saw the flat end of the old one. He bought Coca-Cola not because it was a giant, but because he believed this particular giant was about to have a massive, underappreciated growth spurt. The billion-dollar investment was a bet that the market had wrongly extrapolated the company's recent sluggishness into the future, blinded by the law of large numbers in its domestic market, while completely missing the new, explosive growth engine of globalization. His bet paid off spectacularly. Over the next decade, as Coca-Cola relentlessly expanded its international footprint, the stock soared, multiplying Berkshire's initial investment more than 10 times over and becoming one of the most successful investments in history. The lesson is subtle but profound. Buffett didn't fall into the trap of overpaying for past growth. Instead, he exploited the market's opposite error, underappreciating a new, hidden source of future growth in a company everyone else thought was finished growing. This story cuts to the heart of the psychological principles that lead us astray. The two most powerful biases at play are recency bias and the halo effect. Recency bias is our brain's tendency to take what has happened recently and project it forward in a straight line. When a stock like Nvidia has a phenomenal run, delivering incredible returns year after year, our brains don't naturally think, this is an unusual period of explosive growth that will eventually normalize. Instead, our intuition screams, this is a winner and it will keep on winning. We anchor our expectations for the future on the immediate past because it's the easiest and most available data point. The math of large numbers is abstract, the memory of last year's 100% gain is vivid and emotional. The financial media reinforces this, splashing the high-flying winners across every headline, creating a feedback loop of excitement that makes it almost impossible to maintain a skeptical long-term perspective. The second culprit is the halo effect. This is a cognitive bias where our overall impression of something in one area influences our feelings about it in other areas. We love Apple's products. They are elegant, reliable, and have improved our lives. This positive feeling, this halo, makes us unconsciously assume that the stock, Apple Incorporated, must also be a fantastic investment at any given moment, at any given price. We fail to make the critical mental separation between the great company and the potentially overvalued stock. We see the long lines outside the Apple Store for a new iPhone launch and think, I have to own that stock. We don't stop to ask the crucial questions. How much of that success is already reflected in the stock's $2 trillion market capitalization? What rate of growth is this price demanding from the company for the next decade? The halo of a beloved brand blinds us to the cold, hard calculus of valuation. We become fans, not investors, and in the stock market, fandom is a path to financial ruin. So how do we break free from these powerful psychological currents? We need a practical mental model, a tool to force objectivity. Let's call it the rearview mirror test. It's a simple but powerful exercise. First, take a large cap stock you're considering buying, one that has had a fantastic run. Second, open up its financial statements and write down its revenue and earnings growth rate over the last 5 years. Let's say it has compounded its revenue at an impressive 25% per year. Now, for the hard part, close your eyes to the past. Assume you've just bought the stock. Your job as the new owner is to write a detailed, plausible, and realistic narrative for how the company is going to achieve that same 25% annual growth over the next 5 years, but starting from today's much larger base. This isn't about vague platitudes like, they will innovate, or they will expand. You must be specific. If they grew by adding 100 million new users in the last 5 years, where will the next 100 million come from? Are there that many new customers left in their core market? If not, what new market can they enter that is as large and as profitable as the one they just conquered? If their last blockbuster product generated $50 billion in new annual revenue, what is the next $50 billion product, and what is the evidence it will succeed? For a company with $500 billion in revenue, a 25% growth rate means they need to find $125 billion in new timed revenue next year alone. That's the equivalent of creating an entire new company the size of Disney or Netflix from scratch in 12 months. Can they do it again the year after that? And the year after that, when you are forced to move from lazy, passive extrapolation to the granular, active work of business strategy, the sheer difficulty of the task becomes immediately apparent. You will quickly discover that for most corporate giants, a repeat performance of their past glory isn't just difficult, it's a mathematical fantasy. This single exercise will do more to protect you from overpaying for growth than reading 1,000 analyst reports. It replaces the market's hypnotic story with the sobering reality of arithmetic. The investor who fails to perform this kind of rigorous check becomes part of the 99% who fall into the trap. This is the story stock investor. They operate almost entirely on narrative. They buy a company because they love the product, their kids love the product, and they see it everywhere they go. They read a magazine article calling the CEO a visionary genius. They look at a 5-year stock chart and see that it has gone steadily up and to the right, and they assume this is the stock's natural, God-given trajectory. Their entire investment thesis is based on social proof, the halo effect, and recency bias. They never once ask the foundational questions: what has to be true for this trend to continue? And more importantly, what price am I paying for the assumption that it will? Think back to the height of the dot-com bubble in 1999 and 2000. Cisco Systems was the undisputed king. It was the plumber of the internet, selling the routers and switches that were building the digital world. Its growth was breathtaking. Its story was perfect. It was a great company. Investors, caught in the mania, believed the story was so good that any price was justified. They paid price-to-earnings ratios of over 100, implicitly betting that the company's phenomenal growth would not only continue but accelerate. They were buying the story, the headline, not the underlying business fundamentals. When the bubble burst, the story shattered. Cisco's stock collapsed by over 80%. And here's the truly painful part. Cisco, the company, didn't die. It continued to be a profitable, important technology company. But for the investors who bought at the peak, it didn't matter. It took them more than 15 years just to break even. Their portfolio growth was annihilated for a generation, not because they bought a bad company, but because they paid a foolish price for a good one, a price that had a heroic and impossible future already priced in. This leads us to the direct financial connection, the point where this psychological error manifests as cold, hard numbers on your brokerage statement. It all comes down to the concept of the price-to-earnings, or PE, ratio. The PE ratio is simply the price you pay for $1 of a company's annual earnings. When you pay a PE ratio of 50 for a stock, you are paying $50 for every $1 of current profit. This high price is not a reflection of the present. It's a massive bet on the future. A PE of 50 is the market's way of saying, we believe this company's earnings are going to grow so explosively that $50 will look like a bargain in a few years. But what happens when that explosive growth inevitably slows down? What happens when a company's growth rate decelerates from 30% per year to a still respectable 10% per year? The company is still growing, still profitable, still a good business. But it is no longer a hyper-growth story. And so, the market will no longer be willing to pay a hyper-growth price for its stock. The PE ratio that investors are willing to pay will contract, perhaps from 50 down to 20. This phenomenon is called multiple compression, and it is the silent killer of returns. Let's look at the math. Imagine you buy a stock for $100 per share. It earns $2 per share, so its PE ratio is 50. Over the next 5 years, the company does well and grows its earnings by 15% each year. Its earnings per share are now about $4. If the PE ratio had stayed at 50, your stock would be worth $200, a fantastic return. But because the growth has slowed, the market now only values the stock at a PE of 20. So your stock is worth $4 in earnings times a multiple of 20, which equals $80 per share. The company succeeded, the business grew. But you, the investor, have lost 20% of your capital. You lost money not because the company failed, but because your initial investment expectations, embedded in that high PE ratio, were impossible to meet. This is the trap in its purest form. Understanding this dynamic is the first essential step toward achieving real, sustainable portfolio growth and the financial freedom that comes with it. To truly grasp why yesterday's winners rarely dominate tomorrow, we need to move beyond psychology and into the unyielding realm of mathematics. The core principle at play is the law of large numbers. In simple terms, this law states that as a company gets bigger, it becomes progressively harder for it to maintain a high percentage growth rate. Growth is not a feature of a company, it is a phase. And for the largest companies in the world, that phase of explosive percentage-based growth is almost always in the past. This isn't a theory, it's an arithmetic certainty, an anchor of scale that drags on every corporate giant, no matter how innovative or dominant. Ignoring this mathematical anchor is one of the costliest mistakes a retail investor can make, a mistake that a young Warren Buffett understood intimately, and one that the mature Warren Buffett now lives with every single day. There is no better way to understand the profound impact of the law of large numbers than to contrast the investment universe of a young Warren Buffett in the 1950s with the one he operates in today as the chairman of Berkshire Hathaway. In the 1950s and 1960s, Buffett was managing his investment partnerships, dealing with a relatively small pool of capital, a few $1,000,000. In this environment, he was a financial detective, scouring the backwaters of the stock market for what he famously called cigar butt investments. These were tiny, obscure, unloved companies trading at absurdly cheap prices. He could find a small company selling for $500,000 that he knew was worth at least $1 million. He could put a significant portion of his partnership's capital into this single idea, wait for the market to recognize its value, and often double his money in a year or two. His small size was an enormous advantage. He could fish in tiny ponds that the big institutional fish couldn't even see, let alone swim in. He could find these 10-baggers, stocks that go up 10 times in value, because he was starting from such a small, nimble base. His returns during this period were legendary, often exceeding 30% or 40% per year. Now fast forward to today. Warren Buffett manages Berkshire Hathaway, a corporate behemoth with a market capitalization of nearly $1 trillion and hundreds of billions of dollars in cash and equivalents. The law of large numbers has completely changed his reality. His problem is no longer finding great ideas. His problem is finding ideas that are big enough to matter. For an investment to have any meaningful impact on Berkshire's overall performance, to move the needle, as he puts it, it has to be enormous, measured in the tens of billions of dollars. If Buffett finds a brilliant little company worth $500 million that he's certain will double, he can't really invest. Buying the entire company would add just a tiny fraction of a percentage point to Berkshire's value. The transaction costs and management attention required would far outweigh the benefit. A $100 million profit, a sum that would be a life-changing windfall for any of us, is a rounding error on Berkshire's income statement. Buffett himself has been explicit and refreshingly honest about this for decades. He has consistently told his shareholders that Berkshire's sheer size will make it impossible for him to replicate the spectacular percentage returns of his early days. He is now forced to hunt for elephants, and there are very few elephants in the jungle, and they are rarely offered at bargain prices. His personal career is the ultimate case study in the law of large numbers. The mathematical constraints of size have forced him to change his entire investment style, from a nimble hunter of small, fast-growing gazelles to a patient manager of a herd of massive, slow-moving elephants. The psychological reason we so easily ignore this mathematical reality is rooted in two powerful cognitive errors: the base rate fallacy and what some psychologists call the law of small numbers. The base rate fallacy is our tendency to ignore general statistical information, the base rate, and focus instead on specific, anecdotal information. The base rate information here is clear. Historical data shows that out of all the companies that reach the top 10 by market capitalization, very few will be the best performing stocks over the next decade. Most will underperform the broader market. That is the statistical reality. But what do our brains focus on? We focus on the specific, salient, and thrilling story of Amazon's or Apple's incredible run over the last decade. We let this one vivid example completely overshadow the overwhelming statistical evidence to the contrary. We bet on the exception, deluding ourselves into thinking it's the rule. The law of small numbers is a related bias, where we draw broad conclusions from very small samples of data. We see a company post 3 or 4 consecutive years of 30% growth, and our brain instinctively thinks, this is a 30% growth company. We treat this short-term trend as a permanent characteristic of the business, like its name or its logo. We don't have an intuitive feel for exponential growth, or the sheer scale of large numbers. $1 billion, $100 billion, $1 trillion. These figures become abstract placeholders in our minds. We fail to appreciate the monumental difference in difficulty between adding $1 billion of revenue to a $2 billion company, 50% growth, and adding $100 billion of revenue to a $1 trillion company, 10% growth. The latter is 100 times more difficult in absolute terms, but our brains get tricked by the smaller percentage, making it seem less impressive. We are not wired to think at the scale that modern mega-cap companies operate on, and this cognitive blind spot makes us vulnerable to projecting impossible futures. To combat this, we need another practical tool, a quantitative mental model to ground our expectations in reality. Let's call it the market saturation calculator. This model forces you to confront the physical limits of a company's growth potential. Here's how it works. First, Identify the company's total addressable market, or TAM. This is the maximum possible revenue the company could generate if it achieved 100% market share in its current field. For a company like Netflix, the TAM might be the total number of broadband households in the world multiplied by a potential subscription fee. For an automotive company, it's the total global spending on vehicles. Second, calculate the company's current market share within that TAM. Is it 10%? 30%? 50%? Third, take the company's revenue growth rate from the last few years, that exciting number the market is so focused on, and project its revenue forward for the next 5 or 10 years, assuming that rate continues. Finally, and this is the crucial step, calculate what the company's market share would have to be in 5 or 10 years to achieve that projected revenue. The results of this simple exercise are often shocking. You'll frequently discover that the growth rate implied by the current stock price would require the company to achieve a market share of over 100% of its current market. Or it would require the entire market itself to grow at a wildly unrealistic rate for a decade. This sanity check instantly exposes the absurdity of straight-line extrapolation for large companies. It forces you to ask the most important question: is there enough world left for this company to conquer to justify this price? When you realize that for a giant to grow 20%, it might need to capture 80% of all the new growth in its entire industry, you begin to see the immense headwinds it faces. The market saturation calculator transforms a vague growth story into a concrete problem of market share and physical limits, providing a powerful antidote to the market's boundless optimism. The 99% of investors who ignore this mathematical friction are what we might call the can't-miss blue-chip investors. They see a corporate behemoth like Walmart in the 1990s or Microsoft in the early 2000s, and their thesis is simple. They are an unstoppable force. They are a monopoly. They can't be beaten. They mistake business dominance for investment excellence. They fail to do the simple, back-of-the-envelope math. For Walmart, which today has over $600 billion in annual revenue, to grow by a mere 10%, it needs to find $60 billion in new sales in a single year. That means it needs to generate a new business the size of a Fortune 100 company like Starbucks or Caterpillar every 12 months just to achieve a modest growth rate. The retail investor doesn't grasp this staggering scale. They see the familiar logo, they feel the safety of size, and they assume the momentum is perpetual. They don't see the enormous friction of the law of large numbers, the mathematical gravity that is constantly pulling down on the company's growth rate. They buy the illusion of permanent momentum, and they end up with a portfolio full of beautiful, world-class companies whose stocks go nowhere for a decade. The direct financial connection here can be perfectly illustrated by looking at the core of stock valuation, the discounted cash flow, or DCF analysis. A DCF model is a tool used by professional analysts to estimate a company's intrinsic value. It works by projecting a company's future cash flows out over a period of time, say 10 years, and then discounting them back to the present day to see what they're worth in today's dollars. One of the most critical and sensitive inputs in any DCF model is the growth rate assumption. If a retail investor, captivated by a great company's story, implicitly uses its past growth rate of 25% per year for the next 10 years in their mental model, they will arrive at a valuation that is astronomically high. They will convince themselves that paying $500 a share for the stock is a bargain. A more seasoned analyst, however, applying the law of large numbers, might use a tiered growth model. Maybe 15% growth for the first 3 years, tapering down to 8% for the next 5, and finally settling at a terminal growth rate of just 3%, in line with the global economy. This far more realistic set of assumptions could easily result in a calculated intrinsic value of just $250 per share. The exact same company but a different set of growth expectations cuts the valuation in half. When you pay $500, you are not just betting the company will succeed. You are betting it will succeed according to an impossibly optimistic script. By internalizing the law of large numbers and applying it to your growth expectations, you can avoid this trap. You will anchor your stock valuation in mathematical reality, not narrative fantasy, protecting your capital and ensuring your investment expectations are set for success, not disappointment. The most vivid and destructive example of investors ignoring the law of large numbers and the perils of overpaying for growth is not a recent phenomenon. It is a ghost from market history that every investor should study, a cautionary tale of what happens when a good idea, investing in great companies, is taken to a dangerous and irrational extreme. This was the era of the Nifty 50, a period in the late 1960s and early 1970s when a group of about 50 large blue-chip stocks became the darlings of Wall Street. These were the premier growth companies of their day, the one-decision stocks. The theory was simple. These companies were so good, their futures so bright and certain, that you could buy them at any price, hold them forever, and you would be guaranteed to make a fortune. This seductive idea created a massive speculative bubble, and its eventual, brutal collapse provides the perfect historical laboratory for understanding our core thesis. It also reveals another powerful force that drives these manias, what Warren Buffett calls the institutional imperative. The story of the Nifty 50 begins in a booming post-war America. Companies like IBM, Xerox, Polaroid, Avon, and McDonald's were transforming their industries and delivering phenomenal growth. They were the technology and consumer giants of their time, the equivalent of today's Apple, Amazon, or Google. Institutional investors, like the big banks and mutual funds, began to pour money into these stocks, seeing them as a safe harbor of quality and predictable growth in an uncertain world. The narrative took hold that these were not just stocks. They were American royalty. Their brand dominance, their technological leadership, and their consistent earnings growth were seen as unstoppable forces. The one-decision mantra spread like wildfire. The only decision you ever had to make was to buy. You never had to worry about selling. The quality of the business, the story went, would protect you from any overvaluation in the price. This theory was not just a fringe idea. It became the dominant investment philosophy on Wall Street. As more and more money chased this limited group of 50 stocks, their prices became completely detached from their underlying fundamentals. Price-to-earnings ratios, which historically had averaged around 15 for the broader market, soared to absurd levels for the Nifty 50. It was not uncommon to see these stocks trading at P/E ratios of 50, 80, or in the case of a company like Polaroid, nearly 100. Investors were paying $100 for every $1 of the company's current annual earnings. They were not just pricing in the future, they were pricing in a future of perpetual, spectacular growth that was, in hindsight, mathematically impossible. They had fallen completely in love with the story of the great company and concluded that the price of the stock was irrelevant. But price is never irrelevant. Then came the brutal bear market of 1973-1974. Triggered by the oil crisis and a deep recession, the entire stock market fell sharply. But the Nifty 50, the supposedly safe, buy-and-hold-forever stocks, were utterly decimated. They were the epicenter of the collapse. Xerox fell from $170 to $28. Avon plunged from $140 to just $20. Polaroid, the high-tech marvel of its day, collapsed from a high of $149 to a low of $14. The losses were catastrophic, ranging from 70% to more than 90%. The most painful lesson from the Nifty 50 debacle is this: even though the stock prices were annihilated, many of the underlying timber companies continued to be successful. McDonald's kept selling burgers. Johnson & Johnson kept selling bandages. But for the investor who bought at the 1972 peak, this corporate success was cold comfort. It took them more than a decade of agonizingly flat returns just to get back to even on their initial investment. Their capital was trapped for years, their portfolio growth stagnant, all because they believed the lie that a great company is a great investment at any price. They learned the hard way that when you pay for 30 years of perfect growth up front, you had better hope the company delivers 30 years of perfect growth just to earn a mediocre return. Any hiccup, any slowdown, any failure to meet those heroic expectations would lead to financial disaster. They were not investing in a business, they were speculating on a flawless narrative. This mass delusion was driven by a deep psychological principle that Buffett has labeled the, quote, institutional imperative. This is his term for the tendency of people within large organizations to mindlessly imitate the behavior of their peers, regardless of whether it makes rational sense. In the world of institutional money management, the primary goal for many fund managers is not to achieve the absolute best returns, but to avoid looking foolish and losing their jobs. In the Nifty 50 era, every respectable fund manager had to own shares of IBM, Xerox, and Polaroid. These stocks were the mark of a serious blue-chip portfolio. If you owned them and they went down, you wouldn't get fired, because all your competitors owned them too and were also losing money. You could blame the market, but if you didn't own them and they continued to soar, you would look like an idiot. Your performance would lag far behind your peers, and you would risk losing clients and your job. The career risk of being different was far greater than the financial risk of being wrong with the crowd. This is a perfect example of social proof, one of the most powerful forces in human behavior. When we are uncertain, we look to others for cues on how to act. When every expert and institution is buying the same 50 stocks, we assume it must be the correct and safe thing to do. This creates a self-reinforcing feedback loop. Buying pressure drives prices up, which attracts more buyers, which validates the initial decision and drives prices even higher. The herd thunders along with no one stopping to ask if the path they're on leads off a cliff. To avoid being swept away by this kind of institutional herd behavior, you need a mental model that forces you to take a detached, contrarian perspective. Let's call it the contrarian questioning framework. When you see a large-cap stock that is universally loved, praised by every analyst on television, featured on every magazine cover, and held by every major mutual fund, that is your signal to stop and become a skeptic. First, clearly articulate the consensus view. What is the story that everyone believes? For example, this company will dominate the artificial intelligence industry for the next decade, and its growth is unstoppable. Second, ask yourself, what is already priced into the stock? Do a quick calculation. If the P/E ratio is 70, you know that the market is pricing in years of flawless, high-speed growth. All the good news, all that rosy future, is already reflected in today's price. Third, and most importantly, ask, what could go wrong that the euphoric consensus is ignoring? Is there a hidden regulatory risk? A disruptive new technology from a small competitor? Is the celebrated CEO about to retire? Force yourself to argue the bear case. Actively search for disconfirming evidence. Finally, ask the ultimate question. Could I wait 3 years, see the company actually prove out this spectacular future, and still make a decent return by buying it then, even at a potentially higher price? Or is all of the conceivable good news for the next decade already baked into the price I have to pay today? This framework is an inoculation against hype. It forces you to break from the social proof of the herd and analyze the investment's risk and reward from a cold, rational, and independent perspective. The modern-day equivalent of the Nifty 50 investor, the person following the institutional imperative without realizing it, is often the passive index fund devotee who mistakes broad diversification for invincibility. Many people invest in an S&P 500 index fund and feel safe because they own 500 different stocks. But the S&P 500 is a market capitalization-weighted index. This means the biggest companies have the biggest impact on the index's performance. In recent years, this has resulted in the index becoming extraordinarily concentrated. A handful of mega-cap technology stocks, the modern-day Nifty 50, now account for a massive percentage of the S&P 500's total value. An investor who thinks they are safely diversified is, in reality, making a massive, concentrated bet on the continued hypergrowth of these few corporate giants. They have outsourced their decision-making to an algorithm that mechanically buys more of whatever has already gone up the most. They are, in effect, mindlessly following the institutional herd, buying the most popular and expensive stocks in the world, not because of a rational analysis of their future prospects, but simply because they are the biggest. They have fallen into the Nifty 50 trap without ever consciously choosing a single stock. The direct financial connection that ties this all together is the devastating mathematics of multiple compression, which we saw in the Nifty 50 collapse. Let's make the numbers even more stark. Imagine you buy a wonderful company, a true market leader, at a P/E ratio of 90. The company performs beautifully, growing its earnings per share by a fantastic 15% every single year for 10 straight years. After a decade, its earnings have more than quadrupled. This is a story of incredible corporate success. However, over that decade, the market sentiment changes. The company matures, growth inevitably slows a bit, and the hype fades. The P/E ratio that investors are willing to pay for the stock contracts from the euphoric level of 90 down to a more sober, but still respectable, level of 20. So what happened to your investment? The earnings quadrupled, but the multiple the market was willing to pay divided by more than 4. The net result is that your stock price is now 2 lower than when you bought it 10 years ago. A decade of world-class business performance resulted in a decade of negative investment returns. This is the ultimate trap of growth investing. It's the painful lesson that even if you are right about the company, you can still lose a fortune if you are wrong about the price. Managing this relationship between price, growth, and investor sentiment is the absolute core of effective risk management, and the only way to ensure your wealth management strategy leads to real, long-term portfolio growth. If blindly buying today's giants is a trap, what is the alternative? The answer is not to abandon the idea of investing in great businesses, but to refine our search. The goal is not to simply own the current giant, but to identify the next giant, or, even more subtly, to buy the current giant only when the market has temporarily lost faith in its future. This requires us to navigate the age-old dichotomy between growth and value investing, a distinction that Warren Buffett himself has declared to be a false one. As he says, growth is always a component in the calculation of value. The true art lies in finding growth at a reasonable price. And to illustrate this masterful synthesis, we must look at what might be the most counterintuitive investment of Buffett's modern career: his massive, multi-hundred-billion-dollar bet on Apple. On the surface, Buffett's investment in Apple, which began in earnest in 2016, seems to fly in the face of everything we've discussed. Apple was, and is, one of the largest and most widely followed companies in the world. How could this possibly be anything other than a purchase of a mature giant? But once again, we have to look at the context, the timing, and the reasoning. Buffett didn't buy Apple in 2007 when the iPhone was a revolutionary product ushering in an era of hypergrowth. He didn't chase the stock as its sales and profits exploded in the years that followed. He waited. He watched. He waited until the narrative began to sour. By 2016, the market's love affair with Apple was on the rocks. The explosive growth phase of the iPhone was clearly over. Unit sales were flattening. Wall Street was gripped by anxiety, asking, "What's next?" The consensus view was that Apple was a hit-driven hardware company whose best days were behind it. The stock was trading at a remarkably low price-to-earnings ratio, around 10, a multiple usually reserved for slow-growing, boring industrial companies, not the world's most profitable business. The market was looking at Apple through the rearview mirror, valuing it based on its old, maturing growth story, iPhone unit sales. But Buffett, as he did with Coca-Cola 30 years prior, was looking ahead. He saw something the market was deeply underestimating. He saw that Apple was not just a hardware company, it was a consumer products company with the most powerful and sticky ecosystem ever created. He saw hundreds of millions of affluent, loyal customers who were locked into its world of devices and services. He saw the burgeoning high-margin services business, the App Store, Apple Music, iCloud, as a recurring revenue stream that was far more valuable and predictable than volatile hardware sales. In essence, the market was panicking because one chapter of Apple's growth story was ending. Buffett invested because he saw a brilliant new chapter just beginning, and the market was giving him the opportunity to buy into that future at a price that reflected the pessimism of the past. He wasn't paying for the old spectacular growth. he was paying a very reasonable price for a new, more durable and underappreciated form of growth. He exploited the market's myopia to buy the world's best business at a bargain price, just as its perception was shifting from a volatile growth stock to a durable value stock. The psychological principle that creates these kinds of opportunities is the anchoring and adjustment bias. Our minds have a tendency to anchor on an initial piece of information and then fail to adequately adjust our thinking when new information comes along. For years, the market was anchored on the idea of Microsoft as the boring, old Windows monopoly. When Satya Nadella took over as CEO and brilliantly pivoted the company towards cloud computing with Azure, it took the market years to fully adjust its perception and valuation. For a long time, investors continued to value Microsoft like the slow-growing utility of the past, even as a massive new growth engine was firing on all cylinders right under the surface. This created a once-in-a-generation opportunity for investors who could see the new reality before the rest of the market adjusted its anchor. The same exact dynamic played out with Apple. The market was anchored to the hit-driven hardware company narrative. Buffett was able to ignore that anchor, analyze the new reality of the ecosystem and services business, and buy before the market fully adjusted its worldview and re-rated the stock to a much higher multiple. The biggest opportunities often lie in these moments of transition, when a company's fundamental reality changes faster than the market's perception of it. To find these opportunities yourself, you need a mental model that goes beyond reading financial statements. You need to become a business analyst. This is the scuttlebutt growth vector analysis, a method inspired by the legendary investor Philip Fisher, whom Buffett greatly admired. Step 1. Forget the stock price and the daily market noise. Your first job is to understand the business as if you were going to own the entire company. What were its primary growth drivers over the last 5 years? Was it geographic expansion? Was it a single blockbuster product category? Was it growth through acquisition? Be specific. Step 2. Analyze whether those primary growth drivers are becoming exhausted. Has the company expanded to every major country? Has the market for its core product become saturated? Is it facing new, tougher competition? Step 3. This is the scuttlebutt part. You have to go on a detective mission. Read industry trade journals, not just the mainstream financial press. Listen to the company's quarterly conference calls and, more importantly, the calls of its competitors, suppliers, and customers. Study its recent patents and R&D spending. Your goal is to identify potential times new times growth vectors that are currently small and overlooked, but have the potential to become significant drivers of the business in the future. Is the company developing a new technology in its labs? Is it quietly building a new business line? Is it shifting its business model from one-time product sales to recurring subscriptions? Your objective is to find a company where the market is still anchoring its valuation on the old, maturing growth story, while you can clearly see the new, emerging growth vector that the consensus has missed. This is the very essence of finding growth at a reasonable price, a skill that is indispensable for both sophisticated investors and entrepreneurs looking to understand market dynamics. The antithesis to this disciplined approach is the path followed by the growth at any price, or GAAP, investor. This type of investor is mesmerized by a single metric: top-line revenue growth. They will see a company with 50% or 100% year-over-year revenue growth and immediately buy the stock, with little to no consideration for profitability, competitive advantage, or valuation. They are the investors who poured billions into dot-com stocks in the late 90s that had no earnings and no path to ever making money. They are the ones who buy into the hottest new technology trend, paying 30 or 40 times annual sales, not profits, for companies that are burning through cash at an alarming rate. They make the critical mistake of conflating rapid growth with a good business, and a good business with a good investment. They fail to distinguish between good growth, growth that is profitable, sustainable, and generates real cash for shareholders, and bad growth, growth that is unprofitable, fueled by endless shareholder dilution, and creates no lasting value. They are chasing the story, the sizzle, not the steak. This strategy can sometimes work for short periods in a speculative bull market, but it almost always ends in catastrophic losses, because growth that is unmoored from profitability and a reasonable price is nothing more than a dangerous illusion. A simple but effective tool to bring financial discipline to this process and avoid the GAAP trap is the price/earnings to growth, or PEG ratio. Popularized by another legendary investor, Peter Lynch, the PEG ratio is a quick way to assess whether a stock's price is in line with its growth prospects. You calculate it by taking the company's PE ratio and dividing it by its annual earnings growth rate. A general rule of thumb is that a PE-EE ratio of 1 is considered fair value, meaning the PE ratio is equal to the growth rate. A PE-EE ratio significantly below 1 might suggest a stock is undervalued, while a PE-EE ratio well above 1, say 2 or 3, should be a red flag, indicating you are paying a hefty premium for that growth. For example, a company growing at 30% per year but trading at a PE of 75 has a PE-EE ratio of 2.5. This might be far more dangerous than a company growing at a more modest 15% per year but trading at a PE of 18, which gives it a PEG ratio of 1.2. The PEG ratio is not a perfect solve-all metric, but its great utility is that it forces you to connect the price you are paying directly to the growth you expect to receive. It introduces a crucial element of discipline. It helps you to systematically ask, am I paying a reasonable price for this growth? This simple question can help you refine your investment expectations, improve your stock analysis, and dramatically increase your chances of achieving real, long-term capital gains by finding that sweet spot of growth at a reasonable price. We have arrived at the final and most important pillar, the bedrock principle upon which all successful long-term investing is built. It is the ultimate antidote to the growth trap, the psychological manias of the market, and the fear of missing out. It is the simple, immutable truth that the price you pay determines your return. It is not the quality of the company, the brilliance of its CEO, or the excitement of its story that will ultimately dictate your financial success. It is the relationship between the price you pay for an asset and the future stream of cash it will generate. Mastering this concept, internalizing it so deeply that it governs your every investment decision, is the final step in transforming from a speculator into a true investor. And there is no purer example of this principle in action than Warren Buffett's 1973 investment in the Washington Post Company. The year was 1973. The Nifty 50 bubble was beginning to burst, and the market was entering a grim, protracted bear market. Investor sentiment was abysmal. In this environment of fear and pessimism, Buffett began to investigate the Washington Post Company. At the time, it was one of the most prestigious and dominant media organizations in the world. Its flagship newspaper, the Washington Post, was at the height of its power and influence, having just broken the Watergate scandal that would bring down a U.S. president. The company was a fortress, a blue chip by any definition, with a deep and enduring competitive moat. It was, without question, a wonderful business, but the stock market hated it. In fact, the market hated all newspaper stocks, viewing them as old media dinosaurs. Wall Street was caught up in the Nifty 50 mania for high-growth tech and consumer companies and wanted nothing to do with what it saw as a boring, slow-growth industry. This widespread pessimism created a breathtaking opportunity for Buffett. He analyzed the company and saw that the stock market was valuing the entire Washington Post Company, including the newspaper, Newsweek magazine, several profitable television stations, and other assets, at a mere $80 million. But Buffett, doing his scuttlebutt analysis, realized that the television stations alone were probably worth more than $100 million if sold to a private buyer. By his conservative estimate, the intrinsic value of all the company's assets added together was somewhere between $400 and $500 million. And yet he could buy a piece of this collection of premier assets in the stock market at a valuation of just $80 million. The market was offering him dollar bills for 20 cents. The growth story for the newspaper industry wasn't particularly exciting, but at that price, it didn't need to be. The price was so ridiculously cheap, so far below the business's sober calculated value that it provided an enormous margin of safety. Buffett knew that even if the business performed only moderately well, he was virtually guaranteed to make a fantastic return because his entry price was so low. He invested aggressively, buying a large stake in the company. His investment in the Washington Post would go on to become one of the most successful of his entire career, multiplying his initial capital over 100 times. His spectacular return was locked in not on the day he sold his shares decades later, but on the day he bought them in 1973 because he refused to pay a fair price, let alone a premium price. He demanded a bargain. This discipline of demanding a margin of safety is a direct countermeasure to one of the most powerful and destructive psychological forces in investing: loss aversion. Decades of research in behavioral economics have shown that for most people, the psychological pain of losing a dollar is roughly twice as powerful as the pleasure of gaining a dollar. This is why market crashes are so terrifying and why so many investors panic and sell at the bottom. The margin of safety is a psychological shield against this destructive instinct. Think about it. If you buy a high-flying stock at a PE of 60, your investment is psychologically fragile. Any small piece of bad news, a minor earnings miss, a slight downgrade in growth guidance, can cause the stock to drop 20% or 30% in a day. This sharp, sudden loss triggers your powerful loss aversion instinct, making you feel terrified and likely to panic sell. Now consider the alternative. You buy a solid, good company at a PE of 10, a price that represents a 50% discount to its intrinsic value. This investment is psychologically robust. The stock is already priced for mediocrity or bad news. If the company experiences a setback, the stock might not even go down much because the pessimism is already priced in. This stability allows you to remain calm and rational. It allows you to hold on through turbulent times and even gives you the confidence to buy more if the price drops further. Paying a low price doesn't just improve your financial returns, it armors your mind against the emotional volatility of the market, enabling you to behave like a rational, long-term business owner instead of a panicked speculator. So how do you put this into practice? You need a clear, non-negotiable mental model. Let's call it the margin of safety mandate. It's a simple, rules-based system for making buy decisions. Step 1. Calculate a conservative estimate of a company's intrinsic value. You don't need a complex DCF model. You can use a simple shortcut. For a stable, mature company, you might decide its value is around 15 times its average earnings over the last 3 to 5 years. For a company with more reliable growth, you might use a multiple of 20. The key is to be conservative and consistent. This number is your value estimate. Step 2. Look at the current stock price. Step 3. This is the rule. You must set a strict, predetermined discount you require before you will even consider buying. For example, you might make a personal rule that you will never buy a stock unless its market price is at least 30% below your calculated value estimate. This required discount is your margin of safety. Step 4. This transforms your investment decision into a simple binary choice. Is the current price below your predetermined buy threshold? Yes or no? If it's no, you do nothing. You wait patiently. You don't get tempted to chase the stock higher. You let the price come to you. This simple, disciplined process removes emotion from the act of buying. It replaces greed and fear with a rational, value-based framework. This single discipline, more than any other, is the cornerstone of effective risk management and the surest path to achieving long-term financial freedom. The investor who fails to adopt this discipline is the FOMO investor, perpetually driven by the fear of missing out. This is perhaps the most common and destructive persona in the market. The FOMO investor doesn't have a concept of intrinsic value or a margin of safety. Their only buy signal is upward price momentum. They see a stock that has doubled in the last 6 months, they hear everyone talking about it, and they are gripped by an intense fear that the train is leaving the station without them. They have to get in, right now, before it goes even higher. They buy high, driven by the emotion of greed. Then, inevitably, the stock experiences a sharp correction. The story fades, the price plummets, and that same investor is now gripped by the opposite emotion: fear. They sell low to stop the pain, crystallizing their loss. Their entire portfolio becomes a chaotic record of chasing hot trends at their peak and selling them in a panic at their trough. They are constantly reacting to the market's manic depressive mood swings, rather than operating from a stable, internal framework of value. They have ceded control of their financial destiny to the whims of the crowd. Let's bring this all home with the final, direct financial connection. The link between the price you pay and your future return is pure mathematics. Imagine a company whose intrinsic value grows steadily from $100 per share to $200 per share over the course of 5 years. This is the underlying business performance, and it is the same for every investor. Now let's look at the returns for 3 different investors, based solely on the price they paid. Investor A, a disciplined value investor, waited patiently until a market downturn allowed them to buy the stock at $50 per share, a 50% margin of safety. When the value reaches $200 5 years later, their return is 300%. Investor B buys the stock at what they believe is fair value, paying $100 per share. Their return 5 years later is 100%. Investor C, the FOMO investor, gets caught up in the hype and chases the stock up to $150 per share. When the value reaches $200 5 years later, their return is a paltry 33%. The business was the same, the outcome was the same. But the investment results were wildly, dramatically different. The only variable that mattered was the entry price. This simple example contains the entire secret to beating the market and achieving superior portfolio growth. Your most important decision is not what you buy, but what you pay. Internalizing this lesson is the final promise of a rational, disciplined, and ultimately successful investment journey. You have just spent your time and attention building a powerful new piece of mental hardware. You have moved beyond the simple seductive idea of just buying great companies. You now possess a filter, a way of looking at the most popular, most celebrated businesses in the world, and seeing not just their success but the hidden trap of the expectations embedded in their stock price. You have learned to see the mathematical anchor of large numbers that drags on even the mightiest of giants. You have learned to distinguish the company from the stock, the narrative from the numbers. This ability to think critically about price and growth separates the amateur from the serious, long-term investor. You have acquired a defensive skill of the highest order, the knowledge of what to avoid. But a successful journey is not just about avoiding the pitfalls on the map. It's about knowing which direction to travel. Understanding the growth trap is the first half of the equation. It is the crucial defense that protects your capital. The other half, the offense, is learning to identify the specific qualitative characteristics that allow a business to grow its intrinsic value year after year, decade after decade. It is one thing to know that overpaying for past growth is a mistake. It is another thing entirely to be able to recognize the telltale signs of a durable competitive advantage, an economic moat that will allow a smaller company to become a future giant, or a current giant to keep compounding its value at a steady, predictable rate. That requires a completely different set of mental models, a shift from quantitative analysis to qualitative judgment. The video that YouTube has queued up for you next, the one that is now on your screen, is designed to be that next piece of the map. It is the bridge from what not to do to what to look for. It moves beyond the numbers on a spreadsheet and into the strategic heart of a business. It explores the sources of enduring corporate power, the network effects, the intangible assets, the switching costs, and the economies of scale that create the very value we have been learning how to price. It is the link that connects the discipline of valuation to the art of business analysis. The casual market participant may feel satisfied now, content with having learned how to avoid a common mistake. they will click away. But the true student of success, the individual committed to building a complete mental arsenal for achieving financial freedom, understands that this is a journey of continuous learning. The choice is yours. Is this the end of a lesson, or the continuation of your ascent? The next step is right in front of you. Complete your arsenal. Click and continue the journey.